What's going on, and welcome back to another episode of The Mortgage Mindset. I'm your host, Trevor Otsuka. I'm a licensed mortgage advisor with Barrett Financial Group, and I fund on commercial, residential, and private money for fix and flip and various projects like that. Today, we got a solo show, and we are going to dive right into this week's market update. So, for rates, this is going to be filmed on Thursday, November 21st. So, here's what we're looking at. For a 30-year fixed conventional, we are at 7.04% for national average. For a 15-year fixed, you're at 6.41%. 30-year jumbo, 7.22. 30-year FHA is at 6.45, and 30-year VA is the exact same at 6.45%. So we're going to dive in here and take a look at econ data of what happened this week. Probably the most notable one is going to be existing home sales for the month of October. This is the first time in a while that it's had positive growth. So it was up 3.4% from the previous month. They had reported 3.96 million existing home sales for the month of October, which is quite a lot. And then continued claims and jobless claims was another big market item that happened today. Jobless claims came in at 213,000, and it was forecasted to be 220. So that means that less people are filing for unemployment is the way that I would look at that. Tomorrow, we got a big market mover, which is S&P Global Services PMI. That's going to come out at 6:45 in the morning. And then next week, a couple of things happening. So on Wednesday, November 27th, the day before Thanksgiving, core PCE month over month and year over year for the month of October. This is one of the key measurements of inflation. So this has the capacity to really impact the market, and we'll see what that's going to do to interest rates. So I will be recording this next week. I'll probably record this on Wednesday, just so that I'll have the newsletter ready for you guys on Friday, and we'll talk a little bit about what's going to happen that day. Thursday, market's going to be completely closed, obviously, because it is a major national holiday with it being Thanksgiving. And then on Friday, it's a half day. So the market is going to close at 11 a.m. Pacific Standard Time. There will be some lenders that are still out there working. I'll obviously be working on Friday, but on Thursday, I'm taking the day off. So don't call me. All right. For this week's news article headline. Oh, and then by the way, for the rates. So you can get the information for the rates. Just remind you of this every week. Mortgage News Daily. It's an absolutely free website. It's one of the main tools that I use. They also have a mobile app, so you'll be able to download that onto your cell phone if you are a real estate professional or a consumer. It's definitely handy to have it available to you, and it'll give you a good benchmark of what you can expect for interest rates today. Okay. It does get updated every single day, usually around 10 a.m. Pacific time. And then as the day progresses, if we have a big swing in the market, either an improvement in interest rates or a deterioration in interest rates, they'll update this as well. So you should get notifications on that. So this week's headline, this is from Housing Wire. I will include the link for this in the YouTube video and then also for the podcast description. Here's the title. It says, credit reports will be at least 20% more expensive in 2025, frustrated mortgage execs say. This price surge comes as battered lenders dig out from one of the slowest housing markets in decades. So last year, they did the same thing. And the reason why is because loan origination volume is down. So if people are taking less loans, that means that there are less credit reports that are being pulled. What's kind of bullshit about this, in my opinion, is these credit companies, for example, Experian is probably the biggest one that does this. They sell our consumer data to lenders. So I don't know if you knew this, but it's called a trigger lead. So let's say that I apply for a mortgage loan. That credit inquiry gets tagged to mortgages specifically. And then the credit bureau, like Experian, will sell that information to lenders that are buying lead lists from Experian. And that's why your clients will tell you whenever they apply for a mortgage that they're getting blown up by text messages and random phone calls from lenders that are promising the world just because they are trying to steal the deal from the actual originator that is working on that loan and from that mortgage company. There are ways to protect yourself from this. I'll include a link in this below. It is called optoutprescreen.com. So if you are going to go through the process of applying for an auto loan or for a mortgage debt, I would highly encourage you to go to Opt Out Prescreen. You can opt out from all of that for, I believe it's either a 3, a 5, or an indefinite period of time. So to protect yourself, so you're not getting bombarded with all kinds of miscellaneous phone calls from lenders that you don't even know, that you're not even working with, go to optoutprescreen.com before you get started in your approval process, and that'll eliminate quite a bit of that. So here is the key talking points or the key takeaways from the article. So number one is that it's going to be a significant cost increase in credit reports in 2025. Mortgage lenders are bracing for a minimum of a 20% increase in credit reporting costs, driven by FICO's royalty hike and anticipated price adjustments from credit bureaus. This will push the cost of tri-merge credit reports. A tri-merge is all three bureaus is what that means. So Experian, Equifax, and TransUnion. This will push the cost of tri-merge credit reports from approximately $80 to $100 per borrower to over $100 per borrower, with some estimates reaching $150 to $200 per closed loan, which is a significant increase. Right now, when I pull credit reports for a single consumer on a hard inquiry report, it's about $80. And then for two borrowers, it's a little bit closer to 200. So if it does get up to $200, I mean, that is a 100% increase in my cost to pull credit reports for clients, which sucks. Number two is that impact on lenders and borrowers. It says rising credit costs put additional strain on mortgage lenders already operating on thin margins. For independent mortgage banks, IMBs, these increased costs could erode profitability and lead to higher borrower fees. Borrowers may feel the pinch as lenders decide whether to pass on these costs directly or absorb them to remain competitive in a challenging market. So some lenders that you go to, they might not charge you for soft pull inquiry reports or for your credit reports. Others might have you sign or fill out a credit authorization form and pass the cost of that initial credit report so you have skin in the game to you as the consumer. So we'll see what's going to happen next year with this. Number three, industry adaptation and future strategies. It says some lenders like Rocket Mortgage are adapting by covering credit report fees to strengthen relationships with brokers, while others are factoring these costs into pricing models or reevaluating the number of credit pulls during loan processing. The long-term impact of these increased fees could shift industry practices, encouraging greater efficiency in credit report usage and potentially influencing regulatory decisions about pricing fairness. So to me, that last sentence is pretty big. So if they could influence regulatory discussions about pricing fairness, remember I told you about the trigger leads where these credit bureaus like Experian are effectively double dipping. They're charging the consumer on the front end to have the credit report information aggregated in a nice report and then provided to the lending company. But then they're also turning around and they're selling your consumer data in lead lists to other lenders that are willing to pay top dollar to get that information and now start cold calling you basically without your consent, which is crazy. So if they could put in some type of regulation in that, I know that AIM, which is an organization for mortgage brokers, they're actively trying to pursue some type of legal oversight that is going to block or eliminate the trigger leads altogether. So that's it. Let me know your thoughts on this. Do you think that lenders are going to start passing these fees on to consumers, or do you think that it's not really going to change the market and that the lenders are just going to continue to eat the cost of credit reports? So I'd be curious to know what you guys think on that. But that's going to do it for this week's episode of The Mortgage Mindset. I appreciate you guys for tuning in. It is Thanksgiving next week, so I want to wish you all a very, very happy Thanksgiving. I hope that you have an incredibly blessed holiday with your loved ones, your friends, your family, whoever you have around you for the holiday season. And we will see you guys in next week's show for the newsletter that's going to be going out on Friday. All right. We'll talk to you guys later. Bye-bye.